Welcome back. We've covered the spender who loves to enjoy money in the moment and the saver who excels at accumulating money for security. Now let's talk about the investor, the personality type that's all about making money work smarter, not just harder. If you're an investor, your motto is probably something like, make your money work for you, or compound interest is the eighth wonder of the world. You understand that there's a big difference between saving money and growing money, and you're always looking for opportunities to build wealth strategically. Let me start by saying this. If you're naturally an investor, you have a mindset that puts you way ahead of most people when it comes to building long-term wealth. While others are focused on their next paycheck, you're thinking about how to create income streams that don't require trading your time for money. Let's talk about what makes investors incredibly powerful in the wealth building game. First, you're natural long-term thinkers. While other people get distracted by daily market fluctuations or short-term setbacks, you keep your eyes on the bigger picture. You understand that building real wealth takes time, and you have the patience to let compound interest work its magic over years and decades. Investors are also naturally comfortable with calculated risks. You understand that keeping all your money in a savings account earning 1% interest is actually the riskiest strategy of all because inflation will slowly erode your purchasing power. You're willing to accept some volatility in exchange for the potential of real growth. You're typically excellent researchers too. Before you invest in anything, you probably read annual reports, analyze financial statements, compare expense ratios, and really understand what you're buying. This due diligence protects you from scams and poor investments that trap less careful people. And here's something really valuable. You think in terms of systems and processes. You probably have strategies for regular investing, rules for when to rebalance your portfolio, and clear criteria for making investment decisions. This systematic approach removes emotion from your financial choices, which is huge. But let's be honest about where this personality type can sometimes get in trouble, because even strengths can become weaknesses when taken too far. The biggest challenge I see with investors is becoming obsessed with market performance. You might check your investment accounts multiple times per day, stress about every market dip, and let short-term volatility affect your mood and decision-making. When your self-worth becomes too tied to your portfolio performance, that's when problems start. Many investors also struggle with what I call analysis paralysis. You want to find the perfect investment at the perfect time, so you research, but never actually invest. Meanwhile, time is passing, and time in the market almost always beats timing the market. There's also the risk of becoming too aggressive with your investments. Maybe you start with sensible index funds, but then you get too confident and start picking individual stocks or day trading or buying cryptocurrencies with money you can't afford to lose. The line between calculated risk and gambling can get blurry when you're having success. Another challenge is neglecting the present for the future. I've known investors who live like paupers today because they're so focused on being millionaires in 30 years. But what's the point of having $1 million at 70 if you missed out on living your life in your 30s or 40s or 50s? And finally, some investors get so focused on growing their wealth that they forget to actually use it. They become great at accumulating assets, but terrible at converting those assets into the life experiences and security they were supposed to provide. All right, let's see if this personality resonates with you. Here are 5 questions I want you to answer honestly. 1. Do you regularly check your investment account balances and market performance? 2. Are you comfortable with the ups and downs of stock market investing? 3. Do you often think about ways to grow your wealth passively? 4. Have you ever chosen an investment opportunity over a vacation or a major purchase? And 5. Do you genuinely enjoy researching stocks, funds, or investment strategies? If you answered yes to 3 or more of these questions, you likely have strong investor tendencies, and that's fantastic. Your strategic mindset and long-term thinking are going to serve you incredibly well in building wealth. We just want to make sure that you're staying balanced and making smart decisions along the way. So, let's talk about strategies that help investors optimize their natural strengths while avoiding common pitfalls. First, and this is crucial, set rules for how often you check your investments and stick. I recommend no more than once per week for your regular investment accounts and maybe once per month for longer-term retirement accounts. Checking daily just creates unnecessary stress and tempts you to make emotional decisions based on short-term market noise. Next, implement what I call diversification discipline. This means setting specific rules about how much of your portfolio can be in any single investment, sector, or asset class. Maybe no more than 5% in any individual stock or no more than 10% in any individual sector. Well, write these rules down when the markets are calm and you're thinking clearly. Then follow them religiously. This protects you from the temptation to put too much money into whatever investment is hot right now. And here's another strategy that works really well for investors. Schedule regular portfolio rebalancing. Maybe once per quarter or twice per year, you review your asset allocation and buy or sell to get back to your target percentages. This forces you to sell high and buy low, which is exactly what you want to do, but can be emotionally difficult in the moment. I also want you to separate what I call play money from your serious investments. Take maybe 5 to 10% of your investment money and use it for higher risk, higher reward opportunities. Individual stocks, sector bets, crypto, whatever interests you. This scratches your itch for more aggressive investing while protecting the majority of your wealth in diversified long-term holdings. When your play money performs well, great. But when it doesn't, it's not going to derail your overall financial plan. Now, here's something that might feel uncomfortable but is really important. Focus on your investment process, not your investment outcomes. You can't control whether the market goes up or down tomorrow, but you can control whether you're investing regularly, staying diversified, and keeping costs low. Measure your success by whether you're following your plan, not by whether your account balance went up this month. Good processes lead to good outcomes over time, but good outcomes in any single month might just be luck. And please set aside some money for enjoying your life today. I recommend that at least 10 to 20% of your investment money should be earmarked for experiences, opportunities, and purchases that will make your life better right now. Remember, the whole point of building wealth is to create more freedom and options in your life. If you're so focused on the future that you're not enjoying the present, you're missing the point. Let me recommend some specific tools that work really well for investors. For tracking your overall portfolio performance, Personal Capital is excellent. It connects to all of your accounts and gives you a comprehensive view of your asset allocation, performance, and fees across your investments. For automated investing that removes the temptation to time the market, look into robo-advisors like Betterment or Wealthfront. These services automatically invest your money in diversified portfolios and rebalance regularly, which lets you benefit from dollar cost averaging without having to think about it. And for investment research, Morningstar is the gold standard. They provide detailed analysis of mutual funds, ETFs, and stocks, including expense ratios, performance history, and risk ratings. Here's what I want you to remember. Your strategic thinking and long-term focus are incredible assets. Most people never develop the patience and discipline required to build real wealth through investing. But the goal isn't to have the highest performing portfolio. It's to have a portfolio that supports the life you want to live. Sometimes that means taking a little less risk. Sometimes it means spending some money today instead of investing every penny for tomorrow. If you're an investor who's been too aggressive, consider moving some money into more conservative investments. If you've been too focused on the future, set aside some money for experiences and opportunities today. If you've been checking your accounts too often, delete those apps from your phone and check your balances on your laptop once a week instead. The goal is to find the sweet spot where you're building wealth consistently over time while also living a life you enjoy along the way. Your investing instincts are a huge advantage in building wealth. Just make sure those instincts are serving your overall life goals, not becoming an obsession that takes over your life. In our next module, we're going to explore a personality type that's very different from the investor, the debtor. These are people who are comfortable using credit and borrowed money to fund their goals and lifestyle. Even if that doesn't sound like you, you'll learn some valuable strategies for managing debt and credit strategically. I'll see you there.